Yo, we're going to start with a few basics when it comes to trading. The first goal is just to get familiar with looking at a chart. So, the first chapter is called Timeframe Selection and HTF. That's higher time frame. So we'll go through a couple of things, and then we'll get you familiar with time frame selection first. So if you could follow on my screen, pulling up the window for the chart. And I have the first section of the chapter, which is time frame selection. So time frames are intervals at which price data is analyzed or trading decisions are made. So it's just a smart way of saying what time are you going to trade. Time frames are important for a few different reasons. They help us understand the broader market context. That's especially the case for higher time frames. For example, um, if you look at the chart right now, each of these candles represents a day's worth of price action. So this is a lot of days from October. If you look at the cursor, following the cursor down, you should see the date. It says Wednesday, October 2nd, 2024. So that's back in October. From here to where we're at now, January 2025. And each of these is a day. So that's one day, one day, one day, one day, one day. And then we end up here. So if you can tell, depending on what type of trader you are, what your goal is for the trade. Let's say you bought something here. This is about 2 weeks. You would be holding on to it if you planned on selling it over here. Of course, later on in the mentorship, we'll go over, how exactly to tell when to buy, right? You know, if it were only as easy as just picking this point and waiting for it to go to the moon. But of course, that's just looking at it from a daily perspective. What if you wanted to say what's going on a monthly perspective? Up here, you have your way of selecting intervals, at least in Trading View, which is what I would recommend to look at charts. So in this example, each candle is a month's worth of time. So if you look at it, we were about the same amount of distance or the same number of candles, but we're looking all the way back to 2018 to January. These three candles alone represent 3 months worth of price action. So this took a whole month to get to there. Whereas for this month, it just bounced around in this area. For this month, it bounced around in this area. So using the right time frames, for example, such as the 1 hour, can help us precisely enter and exit trades. So if we look at an hour, this is about a week's worth of information here. And we can see how maybe we only want to hold a trade for an hour or two, or maybe in this case, several hours before it went from this low to this high. If we count, that's 1, 2, 3, 4, 5, 6, 7, 8. 8 hours from here to there if you managed to spot something like this. If we look at it from there to there, 8 hours. Of course, it's not likely you're going to catch the low to high, but I hope you get the idea. Whenever we use time frames appropriately, it helps us effectively manage risk. If we combine time frames, we can get the idea that, hey, maybe right now we're in a bit of a bouncing period, so maybe it's not likely to expect something like a crazy move that occurred over here. Just looking at the way the market is set up, you can see, hey, it's been a little bit more bouncy, let's just say. Of course, we'll go into more detail later on and kind of discuss specific ways to sort out the structure of the market. I also want to mention, in regards to managing risk, um, when you look at how far apart the high is from the low, you want to consider when you actually enter. For example, looking at price where it's at right now, if I enter right now, sorry, if I enter right now with where price is at, and this bottom uh, piece or the bottom of the orange block, if that's where I want to get out, or let's say that's the lowest I'm willing to have price and stay in the position. So if it goes lower than this, I'm out. And then if it goes higher than this, I'm taking profit. You can see right here is a 2.8 risk or 2.8 R, which means for every one, I'm going to get 2.8. So if it goes here, I lose one or whatever I'm risking. So let's say $1. But if it goes here, I'm getting $2.8. Of course, the numbers are going to work out a little bit different, but the math is the same. Just It's just looking at how much you're willing to risk for the game. Just keep in mind that price can go either way. But the idea is that um, using the right time frame will let you set up something that's more favorable. Whereas, let's say if you're on the wrong time frame and it's too high, um, and let's say you think price is going to go down. Let's say price is right here, and you want to put it at the top. And let's say you think price is going to go to about the middle of here, let's just say, just for giggles. But let's say you think that. So that's already a 0.95, which means you could lose one and you would only get back a little less than one if it goes your way. So that's something that's a little bit larger of a risk. And we'll go over that more in detail. But as you can see, look, we got one that looks like this, or maybe we wait for price to come back up a little bit. Maybe we say, hey, let's still keep the same limit up here at the top, but let's, excuse me, let's wait for price to come in here. And then, okay, wrong button. let's wait for price to come in here, and then I think it might bounce up. So I'm gonna take it right there. So we'll just wait for this to happen. It comes up, we take it, we're in. It goes down, we're out before it comes back up. Of course, that's probably not what it's going to do right now, but uh, just setting up the right time frame can let you get something that's sharper. So look, we're on the 5 minute time frame. So that means that everything is 5 minutes. Every candle is 5 minutes. So from here is about 9 o'clock to about 1 o'clock. So this is about 8 hours ago. So, or no, sorry. What am I thinking? 12, 13. Yeah. About 4 or 5 hours ago. So each candle is 5 minutes. This is about 4 hours ago. 4 hours worth of information. And if we wanted to do it here, we're at such a small time frame that we might actually be able to get something that's way better risk to reward. Again, if it plays out, if it does, if it doesn't, there's a lot of other factors to consider. But you can see how going down the smaller time frame or going down to the lower time frames gives you a little bit more precision if you can pinpoint exactly where price is going to hit. That's the trick. That's the magic. But that's how we effectively manage risk using the right time frames. And we'll go more into detail about how to select the right time frames and stuff in a bit. So I just briefly want to go over um, the main time frames. So it's really just looking at the chart and kind of showing you how they look just by selecting through them. So in this case, we'll start with the month. In TradingView, if you double click on the scale on the right or on the bottom, it lets you kind of auto size things a bit. But let's start with the monthly outlook. So when you look at the monthly chart, uh, we want to think in terms of position trading. So this is used to help form HTF, directional bias. So it's just higher time frame. So when we look at price, we start from the top and then we work our way down. So the monthly time frame is about the highest time frame that you'll use. Typically, you know, other time frames come into play with more advanced techniques, but for starters, looking at the monthly will get you a nice bird's eye view. So if you start with the monthly, you can begin to see we have tops or highs, and we have lows. Same thing here. We have highs. So this is not really anything strategic. This is just marking little things just to show you. And then if we were to really want to drill down further, we can go to the lower time frames, which we'll discuss. But talking about the monthly time frame, it's just used to trade the monthly range. So we see a range from here to there, or maybe we see a range from here to here. We're just trying to find opportunities within the monthly range. As a positional trader, you're maybe taking 1 to 2 trades a month, but like two would be pushing it. Positional traders usually think on an institutional scale. So we're talking about a couple of years, as you can tell, if you would have bought here in 2020 and sold here in 21, that's about November to April. It's like almost a year. Moving from here to here is several years. So you can see position trading is long term thinking. Okay, so moving on from position trading and moving to the weekly chart, we start looking at swing trading. So position trading is when you take 1 to 2 trades per year, maybe 3 at the most, probably. So that's not very much trades or very much activity in a year when it comes to position trading. Uh, Swing trading, you're typically trading 1 to 2 times within a month. So it's a little bit more active. If we look at the same swing points that we marked, we can see that there's a little bit more information available in between. So maybe if we look at the point from here, we can see a range to work with. Same thing here. We can see as price fell through, we have a bottom that was formed. Um, and maybe we take a trade here and we hold on to it for a couple of weeks and we end up here. Or maybe we take a trade here when we go outside of the range in this area. Maybe we see, okay, we're outside of the range, so let's buy it. And then maybe we sell somewhere in the middle of the range. Let's just make up a spot and say here. If we did that, we would sell around this area here. And then you can see there's a few times per month where that happens. So if we were to remove all of the drawings, if we were to look at the month, and if we were to say this month to this month to this month, and let's mark this month too. This is all 1 month per candle. We're on the 1 month chart. Let's go back down to the weekly chart. Oh, the lines aren't there. Okay, so sometimes there's a setting on TradingView that hides the things on certain charts. So we have them all on every chart now. Okay, so we have the months marked. So that's 4 months right here. And then we go to weekly and you can see. So there's maybe one buying opportunity here. Other than that, you wouldn't have been doing much. Even right here, I'm not so convinced you would sell or that you would be betting that it goes down. But this is 1 month, 2 month, 3 months, and each one of these is a week. 1 week, 1 week, 1 week, 1 week. You can see there was only maybe 1 or 2 buying opportunities in the past couple months. So you would just be looking to capitalize on a swing, and that happens about 1 to 2 times in a month. If we move to the daily chart, this is more short term, or this is perspective that is more short term. Ranges formed through daily charting align with multiple trading perspectives. So position traders, swing traders, they all tend to look at the daily chart. It's like a central focal point to sort out what might happen, either through the day or through the week, or sometimes even through the month. If it's an important day, uh, it might be the day where you should buy. Um, but the daily chart um, is something to definitely look out for, or to keep your eye on, to make sure you um, don't overlook certain things. Like keep in mind certain highs and certain lows. So is a low to this is a low here, right? And today, if you look at it, it's still going. The price is moving. You can see the candle moving, but um, there's a low, or maybe it might turn around and go to this high. But again, this is one day, so we still have a bit of time left before that actually finalizes. It could turn out green at the end of the day, but you do want to look at the daily chart to stay oriented. But we'll go further as we move along in the mentorship and start sorting out how to use the time frames and how to align them properly and combine them so that way you can position yourself at the right time. If we move from the daily to the 4 hour, you can see uh, the same points we marked earlier kind of show prices at a low point, kind of lining up with these other lows here. So the 4 hour gives us a little bit more information. We can zoom out a bit and see the lines we marked for the past couple of months. We can see there's a lot more detail there on those swings or on those expansions upward. We can see a little bit more information. So maybe if we would have opened here at the low and then sold here at the high before we dropped, you know, we could have gotten a good return. There are techniques to catch good entries, and we'll discuss those further. Right now, we don't want to weigh ourselves down with all of that at the moment. We're just trying to understand how a chart looks. So this is the 4 hour. That's for intraday traders. So the 4 hour is used to trade on an intraday basis. So that's holding things for maybe no more than a day. Uh, the the trades are essentially um, in maybe in the morning, out in the afternoon, or maybe in at night, out in the morning. But they're not held for longer than 24 hours. Whenever you're looking at the intraday time frame. If we move down even further to the hour, we can see things get a little bit more erratic. Usually, when you're using the hour time frame, you're scalping, which are quick trades, usually lasting no more than an hour, a few hours, sometimes even minutes. Scalping is typically low margin, meaning uh, sometimes you're not risking as much, and uh, or sometimes you are risking quite a bit with the hopes of getting a sharp move, a quick and sudden move. So whenever you're scalping, being accurate is a little bit more important. So if you're scalping, you want to try to get a move from like right here to right here. Scalping, a good scalp would be like that. You wouldn't really want to get it. You wouldn't want to have to go through this swing here. That's not the point of scalping. Scalping is meant to maybe even get something like this top from here to this right here. That's what scalping is. Okay. So moving away from trading view, um, you'll have plenty of time to practice on your own, just looking through the charts and switching through chart intervals, from monthly to hourly to 4 hour or 5 minute, 15 minutes, stuff like that. And again, we'll go ahead and talk about how to combine the different ones or the different time frames so that way you can actually get a picture of what's going on in the market. That's for later on down the road. For right now, uh, I want to go ahead and discuss higher time frames. So actually looking at a chart and uh, seeing uh, things from the top down. That's what it means when we look from a higher time frame. So uh, longer duration chart intervals are used for analysis. So that's like looking over the span of a year, over the span of 6 months, maybe a couple of weeks. Um, Higher time frames are typically referred to as the monthly, weekly, and daily charts. Those are the ones that you're usually uh, drawing from or using to figure out key levels and such. They provide a broader perspective, so you're able to see what's actually going on, uh, and you're not sucked into little traps here where you might get the wrong impression or you might get faked out. If you're looking at the 1 hour, since price moves quite a bit there, you might miss the bigger picture and be in a position that doesn't work out. So we use the higher time frame to stay aligned with what is expected to happen. Using the higher time frame allows us to reduce noise by filtering insignificant price movements. So if we're looking at the chart all day, which is not healthy, um, then we might see opportunities everywhere. And of course, um, you can't win every trade. So if you're not filtering out bad decisions, then you're just going to be doing the wrong thing constantly. So uh, if you take a trade every hour, that's obviously wrong. But if you time things right and you're working off the right time frames, um, you can see uh, when it's appropriate to enter. So you're not just kind of click and buy or click and sell. You can kind of see, hey, this is a good time. Price is at the right level. Uh, it's lining up with the higher time frames. So using the higher time frames helps us filter out those price movements that aren't really going to do anything for us. So if we look at this graphic here that I have, you can see that it says higher time frame equals lower time frame. So if we look at the monthly versus the weekly, we can see that there's more information, but it has the same general structure. On the weekly chart, uh, let's say the one to the right, uh, you can see that um, key levels are typically tested before we have impulsive price swings. So I know that's a bit much, but basically what I'm saying is, let's say this is a key level, this bottom. It seems like these two drops tested the key level, both times before there was a swing, like an impulsive swing. Like it's like we hit this key level and we went up. We came down, we hit this key level and we went up. So when you're looking at these candles, you also want to keep in mind that for when it comes to a weekly candle, there's 5 trading days in a single weekly candle. So if this right here was a weekly candle, that would be 5 days of activity. So there's all sorts of invalid entries here and valid entries. So there's a bunch of opportunity to make the wrong choice here. Just because you see a solid candle up doesn't necessarily mean that price is going straight up. We'll go over more of that later on down in the mentorship when we start talking about market profiles. But for now, just know that when you look at a weekly chart or any chart for that matter, you want to keep an eye on the candle and what it represents. When it comes to daily charts, they offer refined analysis. So we'll actually look more into the charts a little bit more. But when you're looking at a daily chart, it's another way to kind of get some more detail. You just want to make sure that you integrate the concepts and the protocols that we go over or that we're going to go over time. So when you're looking at the daily chart, when you're looking at the weekly chart, or when you're looking at the monthly chart, we're going to go over a lot of concepts that you'll put together. And over time, you'll have practice with each concept, and you'll be able to understand um, how to use the different tools that I'm going to provide to you. When you're looking at the daily chart, um, I've said this before, but intraday traders, which are those traders that are kind of trying to take advantage of the range inside of the day. So they're trying to go from maybe morning to afternoon or afternoon to night. They typically use the daily chart to determine their bias for the day. So whether it's the open or the close at the beginning of the day or at the end of the day, um, there's a lot of activity. Um, and the daily chart can give you clues to what might happen throughout the day or what might happen the next day. Um, if you're looking at the higher time frame overall, you should be able to anticipate where the daily candle is headed or where it might close. So if we look at uh, if we really look at it, um, the higher time frame candles, uh, it's really the same price movement as the lower time frame candles, but if we use the correct combination, then we're able to get some accurate entries. If we look at this set of candles is a year worth of information. So if we look at that, that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 candles, well, 13 candles. So let's say each candle is worth a month. So this is a month's worth of information. So this is 3 months that price went down. This is 1 month that price went up. That's 1 year's worth of information. If we look at this group, this is 6 months. Each of these candles, let's say they equal a week or so. I'm not going to do the math, but let's say this is 6 months worth of information. So if you bought here, you're waiting 6 months before you get to sell here, or 3 months before, about 3 months before you get to sell here, or you're waiting about a month and a half before you sell here. So you got to keep an eye on the the important price points and make sure you're looking at the right time frame. If we look at this is about a month's worth of information. So let's say each of these is a day. So 1 day, 1 day. So 3 days, price went up. 3 days, price went down. Price just kind of stayed flat for several weeks, maybe like 2 or 3 weeks, 2 weeks probably. So if we look at this is 1 week. So each of these might be an hour or so, a couple hours maybe. But this is 1 week, and we have all of these candles. This is 3 days. So 3 days, and we have a bunch of candles. So you can see how if you start to use the right time frames, you'll be able to get a good picture. So you can see where the opportunity is. If we align things properly, then uh, you can see a good point to buy or sell at the best time.